The public largely believes the AI gold rush has ended. They see the initial hype cycle fading and assume the window for returns has closed. But they are missing a massive, invisible surge in back-end infrastructure happening right now. We are operating against a harsh macroeconomic wall. Inflation remains stuck at 3%, and the Federal Reserve is holding interest rates firm. The International Monetary Fund recently warned the Fed has almost no room to cut rates this year. The era of cheap money is definitively over. This chart highlights the friction in the current market. The flat line shows borrowing costs remaining high at 3.5%. Beneath it, those rising columns represent hyperscalers like Microsoft, Google, and Meta, pouring $650 billion into capital expenditures this year alone. That volume of immediate capital deployment proves we are looking at a foundational infrastructure build-out. Corporations do not spend hundreds of billions in cash on a tech bubble. The speculative AI startups of 2024 are dead. Going forward, generating returns in the stock market depends entirely on backing the capital-intensive infrastructure that actually supports this network. Because companies can no longer rely on cheap debt to fuel their expansion, they are forced to grow by aggressively slashing operational costs. Welcome to the efficiency era. The technological solution driving this is Agentic AI. These systems have evolved past simply suggesting text or writing code. They act as autonomous agents that execute and complete multi-step tasks. For mainstream American businesses, the labor pool is shrinking and high-skill roles remain unfilled. Agentic AI directly solves this critical labor bottleneck by automating expensive, time-consuming workflows. This presents a dilemma for you as an investor. You know this unglamorous back-end transition is critical, but you have to figure out how to allocate capital without overpaying at what looks like the top of the market. To navigate this, you have to abandon the hype-driven narrative. The only metrics that matter now are cold, hard free cash flow and absolute pricing power. This comparison matrix provides our evaluation framework. We are measuring the asset, its role, valuation risk, and its specific moat. Let's look at the first group, the foundations, featuring Microsoft and NVIDIA. The input requirement here is steep. To gain entry to these specific assets, you must swallow premium, trillion-dollar valuations. For NVIDIA, that valuation is backed by the Blackwell architecture. It requires highly complex, capital-intensive manufacturing facilities, creating a physical barrier to entry for competitors and securing a 75% gross margin. Financially, this translates to $68 billion in quarterly revenue, allowing the company to execute massive stock buybacks directly benefiting shareholders. Microsoft secures its position through absolute dominance in software distribution. Azure is re-accelerating toward 50% growth because Microsoft forces their AI tools directly into tens of thousands of existing, deeply entrenched enterprise workflows. The high valuation risk attached to these foundations is offset. Their unmatched free cash flow generation and absolute pricing power heavily insulate them against macroeconomic shocks. Returning to our matrix, we shift to the second group, the digital plumbers, populated by Marvell Technology and Astera Labs. The core technical problem in modern data centers is a connectivity bottleneck. Raw processor speed means absolutely nothing if the data transfer between the chips is choked. Marvell solves this issue using optical interconnects. These are the physical, high-speed highways running between massive data centers, and they are generating billions in necessary networking revenue. Astera Labs tackles the internal server constraint. Their specialized fabric switches act as a mandatory connectivity tax on complex AI servers. As chips get more sophisticated, Astera Labs hardware becomes increasingly indispensable. The specific trade-off for this group is technological risk. Their financial moats rely entirely on current chip architectures remaining stable. These digital plumbing stocks offer higher explosive growth potential than the foundations. However, you must be willing to heavily underwrite the risk of hardware obsolescence in a rapidly evolving sector. Completing our matrix is the final group, the physical constraints, featuring Vertiv holdings. AI hardware is bound by the inescapable reality of thermodynamics. Next-generation chips run extremely hot, pushing server rack power densities well past standard physical limits. Vertiv addresses this through mandatory physical infrastructure. You cannot operate these facilities without their advanced liquid cooling and complex power management systems. The financial evidence for this thermodynamic demand is sitting on Vertiv's balance sheet right now, a record-breaking $4.3 billion order backlog. The major trade-off here is capital intensity. Frictionless software can scale overnight, but Vertiv is a heavy industry business, entirely bound by physical supply chains and manufacturing limits. Vertiv simply cannot scale instantly like code. Yet, their financial moat is strictly guaranteed by the physical laws of heat generation inside every single new AI facility built on Earth. This flowchart, the 2026 AI allocation map, synthesizes our analysis to answer one central question: what is your primary investment goal? We have a path for the stability optimizer. This is for the investor who requires proven, highly dependable cash flow and low volatility in their portfolio. You willingly accept higher upfront share prices on Microsoft and NVIDIA, and in exchange, you secure safety through entrenched, unshakable monopolies. Alternatively, we have the path for the infrastructure capitalist. This maps to investors who will gladly accept supply chain constraints and tech shift risks to capture higher growth. Here's that absolutely must be cleared for AI to function. There is no universally perfect AI stock. Your choice depends entirely on whether you are buying safety or betting on the bottlenecks. There is a third, highly dangerous path you must avoid. Do not fall into the speculative trap of upcoming neocloud IPOs or consumer-facing meme investments. In a strict 3.5% interest rate environment, any company that is not currently generating revenue through labor automation or critical hardware infrastructure is a toxic liability. The stock market is experiencing a massive permanent divergence. It is splitting between the AI haves that command real pricing power and the AI have-nots struggling to survive high debt costs. Ignore the daily noise of interest rate headlines. Keep your capital strictly focused on the underlying plumbing, because that infrastructure is powering the next decade of the American economy.